All right, I have one of the best resources for what to do with money, understanding the US and global economy. This next guest is going to shoot straight with us. No pretending that things are great. No pretending that we're living in la la land. We're going to get right into the nitty gritty, the dirty, and the good of what's going on, so that you and your family can be prepared for upcoming recessions and survive and then thrive again. Lior, thank you so much for coming on today's show.
Thank you for having me.
Let me do a brief introduction. This is Lior Gantz. He is the founder of the Wealth Research Group. It's one of the best free newsletters out there on where to make moves with your money, understanding where the next world war could start, what's going on with Russia, Ukraine from an economic standpoint, what's going on with gold and gold mining companies. And so I'm grateful to have you on, Lior. Let me jump into the first question here. There's a lot of chatter online about the BRICS nations. They have just made a huge global announcement that within the next 30 to 45 days, they will be rolling out a gold-backed currency. Now, over 40 nations around the world are saying, wait a minute, a gold-backed currency compared to the US dollar, that sounds safer, that sounds more stable. Where do you see this leading? Is this going to crash the US dollar overnight, or will this be like a losing power and buying power over time? What do you make of this new story that just came out?
Yeah. First of all, the BRICS countries are an association. They're not a real economic union. It's not like the European Union where there's binding agreements, pacts, trade agreements, etc. It's more like a think group that works together to further the agendas of these five countries. So that's important to consider, because they don't have the framework necessary to create any meaningful currencies. So if they are working on something, as announced by the Russian embassy, like a gold-backed currency, it may be that they roll it out very slowly or in a small manner, see the demand for it, use it just in select transactions, maybe use it between governments for very small oil deals or weapon deals, etc. And that would not be something new at all. In fact, in any time of war during the 20th and 21st century, and obviously before that for thousands of years, governments have settled and monarchies have settled transactions in gold and silver. Yeah, so it wouldn't surprise me at all to see any sort of settlement created with gold. In the past year, meaning 2022, central banks have purchased more physical gold in one calendar year than in any other year in history. So that's important to keep in mind. There is a true process of de-dollarization. It really started to intensify after Obama's speech in 2011, where he started to talk about the fact that America is shifting its priorities from the Middle East to the South China Sea, and it progressed after Trump's election, and certainly after his UN speech in 2018, where he basically said, look, every country needs to pay its fair share, 2% of GDP, to NATO. And that created this dynamic that America is now focused on China, not on the Middle East. They've solved the oil problem that they've had, which prompted them to go into the Middle East in the first place. They have shale oil and they're net independent. Now, politics can come into oil and nat gas, but essentially, at this point, if the United States chose to, it would be 100% independent when it comes to oil and natural gas. And then, obviously, with everything that happened during the lockdowns and the opening up, the world has shifted its entire priority, and it's deglobalizing. The world of hyperglobalization that we've seen since 1991, after the fall of the Soviet Union, which should have ended globalization, essentially, but it only put it on hypercharged mode. So that world is finished. We are we are in a process that will take 5 to 6 to 7 to 8 to 9 years, whatever it takes, and we're entering this new global regime, which is deglobalized, which is multipolarized, and in that world, the dollar is no longer this monetary unit that has to be used by all countries. And the United States knows this. That's why it's sanctioning the hell out of anyone that aggravates it. And it knows that by weaponizing the dollar, it makes it less relevant. And that's why central banks are shifting to other forms of hedges. Now, because there isn't really another great currency out there, another fiat currency that's as liquid and as reliable as much as the dollar isn't reliable. It is the most reliable of all the other fiat currencies in a large scale. Central banks are choosing gold, and so it doesn't surprise me at all that we're seeing calls for gold-backed currencies. Certainly not from countries that would like nothing more than to continue to weaken the U.S. dollar.
So the U.S. dollar is the best looking house in an ugly neighborhood, basically. And now people are saying, wait a minute, let's bring gold back. So let me just clarify for my audience and even just myself. So the BRICS nation is real. It could be a future threat, but as far as working together, it's 40 nations with 40 different presidents, 40 different languages, trying to come together against the hegemony of the United States. But at the same time, there's so many dollars out there that it provides incredible liquidity. But you're saying that central banks are seeing this and now they're buying gold at the fastest rate we've ever seen?
That's correct. Now, let me really explain this. And if you want to truly understand what's going on behind the scenes, go to wealthresearchgroup.com / Saudi Arabia to understand, or / MBS, which is the acronym for Mohammed bin Salman, the heir to the throne of Saudi Arabia, to understand how the petrodollar system itself is now put into question. Because what the Americans did in 1968, when Charles de Gaulle, the French president then, questioned the 35-to-1 ratio that the dollar had to gold, and said basically, hey, without an audit, I don't believe that you can cover $35 with 1 ounce of gold. I just don't believe it. You spent so much money in the Korean War in the 50s and in the 60s in other conflicts. There is no way that your gold to dollar ratio is maintaining the 35-to-1 ratio. Therefore, I want either my gold back or an audit. And he literally, Charles de Gaulle even sent a French ship to New York in the late 1960s, and he wanted to repatriate his gold. At that point, Nixon and Kissinger were really frantic that if other countries do the same, the dollar-based system will be over. And so in 1971, when Nixon basically halted the gold window and created the fiat monetary system, in order to create demand for the dollar, Kissinger went to the Saudis and told them, look, in exchange for reliable supply of oil for us and for our allies, we will protect the Hormuz Strait and the entire Persian Gulf to your interest against your arch enemies in the Persian Gulf and in the Middle East, and you will get rich. The world will have, or our allies, our Western allies, the Europeans, etc., will have their oil, and you will only do this in dollars. And that's the petrodollar system that we have today. So it's basically naval support for the Saudis in exchange for only oil transactions in the dollars to the allies. And what's happening in the last 2-3 years is the Saudis have realized that because the Americans no longer have a vested interest to stay in the Middle East, and because of the shale revolution, they no longer are dependent on Saudi oil, that they can now look elsewhere, the Americans. And that's really concerning to the Saudis. The Saudis, they have a really modern military, but it's just not trained. So they have all the equipment, but they just don't have the culture of defending themselves. They relied on the Brits, than they relied on the Americans. And so now the Chinese are really stepping in, and we already have yuan settled transactions between the Saudis and the Chinese. That's a big FU to the Americans, and it tells you, just like Mohammed bin Salman told us recently, that we live in a multipolar world and not a one polar world where everything gravitates towards the Americans. And so in this world, there are a lot of alternatives getting created for the US dollar settled transactions in oil and other commodities. Just in the past 23 years, in other words, in the 21st century, the role of the dollar in global transactions has come down from about 71% to just under 60. So that's a huge chunk that went to the euro, to the yen, and now to yuan. And that will continue. We have to keep in mind America is only 5% of the global population. Its GDP is going to be surpassed by the Chinese in about 2, 3, 4 years, and its military spending will be surpassed by the Chinese by 2030. So we are moving into a world with clear two polar opposites. And what we think is going to happen is we will not have a full dethroned reserve currency, but we will have some sort of an alternate reserve currency with some sort of a conversion rate between them. So in other words, the Western Bloc will have continue to settle in dollars or in euros, and the Eastern Bloc, or countries that follow China, will use yuan or some other form of currency, or a basket of currencies to settle transactions. And between the two blocks, you will have some sort of a conversion rate. So definitely look at that at wealthresearchgroup.com/Saudi and /Petro, because obviously I can't go into all the details of this in one answer.
Yeah. No, well, you did a great job of educating us, and that's what I see, is I don't think overnight the dollar suddenly becomes irrelevant. There's so many dollars out there. It provides, like you say, that liquidity, but at the same time, China is making moves the United States is not making, and that's building more trust in them and their currency compared to this current administration and our currency. And so it'll be really interesting to see how that all plays out. Now, on one side of news media today, it talks about how there's so much demand to fly and travel that the American airlines are not able to keep up with this hot demand from America, right? On the same page, it says Disney announces that they have their slowest summer week since the Great Recession. People are just not going. They're not spending that money. Is this a sign of priority spending, meaning, hey, I need to travel for a funeral or work, but I don't need to travel for Disney, or Disney is becoming too woke for my family. They're not supporting family value. Where do you think this is going? Or is this just a sign that the economy is finally starting to slow down?
Yeah. So I personally have spent the last 3 weeks in France. I wanted to see with my own eyes what's going on in that country, because of the riots. And by the way, while I was there on the looking at the riots because of the pensions that were raised from age 62 to 64, there was a death of a teenager by a policeman that started other forms of riots. But what I want to tell you is France is packed. France is packed. There are lines outside of luxury fashion brands. There are lines everywhere. The airports are packed, and it's not just France; it's the entire continent. So Europe is doing amazingly well, and a lot of Americans are coming. So there are a lot of Americans that are just choosing Europe over Disney. Perhaps it's because they did Disney during the lockdown years when it was hard to travel internationally. People are doing that internationally, but when you look for signs of a slowdown, we have to keep in mind that because of what's happening right now, from the deglobalized perspective, people in the West are fully employed. And that's a very different scenario than a classical recession. What we're seeing right now is a shift of jobs back from the East to the West. During the last 2 years, China has made it really difficult for companies to operate within China. And the arbitrage of salaries and everything else that used to exist in the 80s and 90s and the 2000s, where you would take your company and do your manufacturing in China or in other countries in the East, that gap is shrinking a lot when you take into consideration all of the risks involved. And so there are so many companies that are moving back either to Europe, the United States, or Mexico and Canada, and that's keeping a lot of people employed. And so very differently from a classical recession where companies have to lay off people, companies are not doing that. They're hiring in some sectors, and in other sectors, they rather keep people on than fire them because it's been so challenging to bring back people from retirement, people that have retired during the pandemic years. So that is one factor of this. The big factor that most people just don't realize the severity of it is that China's rural to city migration, the urbanization of China, the never-ending pot of cheap labor that you can train and put to work has been exhausted. China has been shrinking for the first time in decades. Let me just explain how important this is.
Okay.
During the one-child policy era, China mandated 336 million abortions.
Wow.
Yeah. The entire country has been built on a culture of one child per family. And so they are doing their hardest and their darnest to incentivize couples to have more than one child. They're giving away homes, they're giving away mortgages, they're doing everything, but people just do not want more than one child. And so what you have is an aging population that cannot be replaced. The working force or the productive part of society, the taxable part of society is shrinking without there being any catastrophe, any natural disaster, or anything else. It is the greatest ever shrinkage of demographics anywhere seen in the world at any time during human history is what's going on right now in China, and it's going to go on for the next generation. In the last 20 years alone, China's compensation, in other words, their hourly salaries have gone up by 20 times. It's not cheap to do anything in China. If you look at the world, there are about 200 countries, about 50 of them produce cheaper than China. China is not a cheap country to do business in anymore. And so when you look at the other countries that are cheaper, the 50 other countries, these are not countries that have scale like China. Point being that there is a shortage of workers in the West and elsewhere that's created because of this demographic cliff that the Chinese are facing. And my point is to tell you that we're not living in any sort of real classical slowdown recession. We're living in another form of slowdown, which has to do with a reset of the entire global economic system, because we're deglobalizing and changing our entire way of supply chains around the world. And that is basically why you see so much inflation. Because if I can give you just the simplest analogy, think about you surprising your wife. You furnished the whole house. You just spent $30,000 doing the whole house. She comes in, you cover her eyes. She comes in and you're like, surprise, and she hates it. She can't stand anything. She's like, that's it. And you pulled out all the tags. Like, you can't refund this. What do you have to do? You have to buy $30,000 worth of new furniture after you just did that. That's why this is so inflationary, because you just spent 60K on furniture. We have built our supply chains in China and in the Far East, and now we are literally doing all this investment anew in other places around the world. And that's very inflationary because you're training new people, and it's creating a spiral in salaries and whatnot. So we are living in an inflationary reset that has a labor shortage attached to it, and the end of globalization in terms of the availability of cheap labor attached to it. So those are the things that keep people employed and therefore vacationing. I think the Disney thing is a Disney problem that they have as a company. Other companies are flourishing, and I don't think that it's anything that indicates anything across the board. It's a Disney problem. People are traveling, people have money, and people have about $10 trillion. Just understand that number: $10 trillion sitting in money market accounts right now. That's an all-time high. That's so far above anything else that my point is that the American consumer is wealthier than you think, because the American consumer is comprised of many baby boomers that have worked their entire lives and saved, and the millennials that have inherited their jobs or inherited their fortune, in the case of deceased ones, have saved a lot. Because of 2008, people have had the mentality more of saving than before, because they've seen so many catastrophes happen to them. So we have a lot of money sitting in money market accounts. We have a lot of money moving back to the West, a lot of investment moving back to Europe and America in terms of manufacturing. And therefore, this is really not a classical recession, but it is a severe slowdown because of central banks raising first of all, raising the interest rates, which make it so much harder to justify borrowing, right? If I have to borrow at zero rates, I can fund almost any project, be it risky or not. And that's what you saw during the era of zero interest rates. But when you have to pay 6 or 7 or 8% or 10 or 12% for funding your business, then you focus on profits and not on growth. So this is really what's happening right now. There's a slowdown because you're raising the difficulty to grow a business. Companies are focusing on the bottom line, on profits, because they just can't afford to grow with leverage. So that's a big change that's happening around the world.
Yeah, no, I thank you. I appreciate that that insight and also that analogy, because I guarantee you right now there are people listening to this interview between us, and they're saying, I'm still feeling inflation. It sure feels like a recession to my wallet. It sure feels like a recession to my budget. And it's just as the world is shifting money around, people are focusing their attention in different areas. Jobs are being brought home. People are raising prices to bring in, more employees. It's driven those prices up, and they're not going backwards. And so I think for a lot of my listeners, they're sitting here going, okay, I get that we're not in a recession, but my monthly budget feels like a recession.
Exactly.
Especially if you're lower income, retired, or you're middle class. Anything above that, they're like, wait a minute, my priorities have been shifted. I was forced to lock down, wear a mask, go where I didn't want to go. Now I want to go where I want to go. And maybe I'm not going to save that money for retirement. I'm going to go see France. I'm going to go see Israel. I'm going to go wherever. And so it really is like, we're it feels like a new world. COVID.
We are in an inflationary reset and not a recession. That's why you feel like, man, I have a job, but my mortgage has gone up by $1,500 dollars a month. My budget when I go for groceries has gone up. I am not seeing any boom because there is no boom. There is an inflationary reset, and it's very hard to understand that, hey, I have a job on one hand, but my life is way more expensive on the other. So then it becomes a game of priorities, as you say.
Yeah. Okay. In our last few minutes, because I know that we have time constraint, you're a very busy guy. I appreciate you coming on. Let's talk about gold and silver for a minute. I know those are things that you like. If central banks are basically showing their poker hand that they are buying gold at the fastest rate ever, many perfect portfolios show, okay, you should maybe have 5 to 10% in precious metals, depending on how conservative you are or how averse to risk you are. Has that percentage changed in your mind as fiat currency gets out of control? And where do you see gold and silver going over the next 12 to 24 months?
Okay. So personally, I think that in today's world, because we live in a world with a lot of central bank intervention and a lot of government intervention, if you look at any of the worst crises that we've seen, at least in the last 25 to 30 years, they are very short-lived. So a 2-year crisis is we can say it's pretty much as long as we've seen, where for 2 years you're struggling. And therefore, my strategy has been to calculate how much my family burns on a monthly um, uh, budget. And for theoretical purposes, let's say it's $5,000. Then what I want to do, my strategy, is to take that $5,000, multiply it by 2 years or 24 months. So 5,000 times 24 be, in this theoretical exercise, $120,000. And I want to convert that much savings power into physical gold, 80%, physical silver, 20%. And that to me has always been the gold standard of how I should own gold. Because if I can have 2 years worth of my current living standard in gold and to a degree in silver, then I feel like I am protected in case that there's a severe recession or a depression. So that's number one. Then if that becomes not enough, then I can raise it to 5% of my net worth if 5% of my net worth is more than that $120,000 amount. So it's either 5% of my net worth or 2 years worth of my living expenses, whichever is greater. And that to me settles the entire case of how much gold and silver physical one should own. Either 2 years worth of your living standards or 5% of your net worth, the greater of the two. I think that you should not do less because if you look at the superiority of saving your money in gold and in silver during the last 52 years since we embarked on the fiat monetary system, it's been showed time and again that it's just superior to any other form of currency. In other words, 1 ounce in 1971 was $35 an ounce. Today it's reaching 2,000. So it's done almost a 55 to 60% to 50 times move, or it's mind-boggling. Just in the last 23 years, in other words, in the 21st century, gold has done even better. If you look at the 52-year annual compounded rate of return, it's been about 6.6%. But if you look just in the 21st century, it's reaching 8%. That's better than the S&P 500. So you're talking about a non-productive asset that doesn't yield any dividend, that's producing better rates of return than the most dynamic index of stocks in human history. So yeah, I do feel like people should definitely own physical gold and silver to that degree. What was the second part of that question?
Oh, just basically, do you think that that has shifted over time as fiat currency? So, for example, let's say 5 years ago, you and I have a
Do I
private
feel safer or
conversation.
riskier than before?
Yeah. You say to me 5 years ago, hey, you should have 5% of your net worth in this. Now, after COVID, after the fiat currency, this BRICS nation threat, a change in central banking, I'm just wondering if that 5% should be higher if we believe it's going to be such a good producing asset over the next decade.
Well, for a low income person or somebody with just starting out or whatever, he should use the 2 year barometer. So, in other words, if his net worth is very minimal, then shoot for 2 years worth of living expenses, and that should be a lot for you. So, I don't think that that will change. Like if you think about the last 5,000 years and people having this kind of conversation, 1,000 years ago or 2,000 years ago, could you imagine like somebody 1,000 years ago telling his friend like, hey, the water is contaminated. Like we can't drink water here in Europe. All the ponds are dirty with germs and everything. We have to resort to whales and everything. The world used to be much scarier. All the cities were burning with matchsticks. So I don't think that's the point. I think the point is to understand the value proposition of owning physical precious metals over time, and giving it away to the next generation when it's time to. That's one. I don't think that will change. And to the degree that the human society needs gold and silver, I think it's the same as the day they found it originally in Latin America or wherever else, and said, "Man, this thing is a unique element of nature, and we should use it." So that's one. Secondly, you asked me about the next 18 to 24 months. So the way I see it, what we've seen is one of the most aggressive tightening cycles ever during modern central banking. We have not seen a Paul Volcker type experiment, but we have to realize that Paul Volcker lived in an era where the Fed didn't hold press conferences. It's kind of weird to think about it today, because
Yeah.
today they issue, hey, here's what we're gonna do, here's what we're thinking, here's what they're telling you a year ahead where they think inflation is. When Paul Volcker took the job of chair and raised the Fed funds rate by from 10% to 20% overnight. Think about that, doubling the interest rates of America. He did not tell anyone that until the next morning when you saw it on your New York Times. So we're not going to see that. That's not the way the Fed works today at all. The Fed took us from 0 rate to over 5 today, and probably in about 2 weeks from now, exactly on the 26th, they're probably going to raise rates by another quarter percentage point and take us to between 525 and 550. That's a very high rate of Fed funds rate. That's very restrictive. And I think that after that, we will have a period of wait and see, because there is a lag effect, which they don't know how severe it is. And they already know that they can create problems for regional banks, and they know that the real estate market is frozen, and there's a lot of debt that has to be recycled in September. So if anything, I think that they wait. And after they wait, if the market starts to become convinced that that's it, that the next step is somewhere in 2024 to start cutting back, then gold is probably going to all-time highs. I do want to tell you a few things about gold that are very interesting. On April 1st, 2019, the BIS, which is the Bank of International Settlements, it's situated, headquartered in Basel, Switzerland. It's basically the central bank of central banks, and it changed gold from a tier 3 to a tier 1 asset on April 1st, 2019. Tier 3 is where you can use gold as 50% collateral. In other words, if you have $1 million worth of gold, it's worth 500,000 in collateral. There are only 2 tier 1 assets in the world: treasuries, which are considered the safe haven asset for the universe. The barometer of everything else is the debt that Washington issues. We can debate whether or not it's true. And the US dollar. Those are the tier one assets, according to banks. On that date, they changed gold from tier 3 to tier 1, making it 100% collateral. So if you think about it, gold was trading for $1,291 an ounce the day they did that. And what they basically told you is, hey, we're changing it from tier 3 to tier 1. In other words, we believe it's worth double that, double 1,291. So in other words, they believe it's worth 2,582 an ounce. That's in April 1st, 2019, before the monetary base became even more ludicrous during the shutdowns, etc., where they issued $6 or $7 trillion more. So at this point, gold is worth anywhere between 2,500 and 3,000 an ounce if you look at the potential for this bull market, and perhaps even more. There are many ways to look at it. One way is to look at how much the price of gold should be in order to cover about 20% of the monetary supply. And that takes you to $24,000 an ounce gold. Not to mention to cover the entire monetary supply. In 1980, when gold was $850 an ounce at its peak, if Paul Volcker did something else, which is to repeg the dollar to gold, he would have been able to cover the entire monetary supply of the United States. He would have been able to create a gold-backed dollar at $850 an ounce. Today, to do that, it's about $36,000 an ounce. We're nowhere near covering our monetary supply with gold. So there's a lot of ways to think about how undervalued gold is. The point is, in my opinion, that saving in gold is the right way to go, and that once the Fed starts to signal that they've stopped raising rates, and the next step is probably wait and see, and then to cut it back down, if inflation continues to trend down, I think that gold can be worth well over 2,000 and probably into the 2,500s and the 3,000s. My opinion on silver is a bit more bullish, because I think that we're entering a dollar bear market for the next 5 to 6 years, because I think that the 2024 presidency will be all about fiscal responsibility. And because of high interest rates, in order to service the debt, it's the incentive of Washington that we have a weaker dollar, so they can pay their debt down and inflate it. And I think that with everything we said previously about Saudi Arabia and China and the de-globalization and de-dollarization of the world, I think that the dollar index, the DXY, which right now it's about 105, I think it's going to go down by about 20-25%, which is huge for a currency. It's a huge currency move, and that will probably take us to silver over 50 and probably over 60 an ounce during this decade. So I do think both of them look very promising. And if you want to check out like my personal portfolio, my entire portfolio that took me years to create, you can go to wealthresearchgroup.com/portfolio and actually access it for free right now. So
Okay.
that's just as an overall picture.
Okay, I'll make sure to put that in the link in the show notes down below. Lior, this has been a fascinating conversation, helping us really understand why things are so expensive, where the world's going, what could go wrong with China, what could go right with China. On our next conversation, maybe we talk about the research that you and your group are working on where World War III will start. We've run out of time, but I think that's an important message, and we'll definitely have you back on the show. Thank you so much again for coming on, and I'll make sure to put those links in the show notes down below.
Thank you, sir.